Yo, welcome back. Today I'm gonna be speaking about liquidity and where the liquidity lies and more key points about liquidity. So like slippage, institutions like banks and just normal day-to-day traders and what effects they have on the market. First of all, I'm gonna start very simple. Where liquidity lies. Liquidity comes from buyers in the markets and sellers in the markets, but mainly from institutions of banks and like just big buyers like us day traders, especially on prop firms. We have no effect on the market because we're not actually using proper money. We're just using demo accounts. Even when we're in a live phase, it's not real money, unless some prop firms do have live accounts that they put you on if you are really profitable. But us traders on prop firms don't have any effect on the markets at all. So let's get into this a little bit on the charts. We've got highs up here, we've got lows. All of this is lying liquidity, sweeping traders out the markets. So say we've got price line up here, we're taking out sellers of the markets because we're pushing up higher. People might have their stops here, here, and here, and price is pushing through there, and then we've taken all this volume has taken all this liquidity out of the markets for it to begin trading lower again, and more sellers in the market taken out after we've taken out all of the buyers. So I'm gonna talk a bit more about things like slippage. Let's go on to slippage actually, because slippage is a very important thing in the markets. For example, this big gap. This is why, like, as a swing trader, I don't really want to be holding positions over the weekend at the minute, because things like this, like price closing over weekends, like this is Sunday, and then we get like market open over here. So say you're in a position and you've got a stop loss set, price doesn't take you out at that stop loss, it takes you out at the next available price. So let's say we had a short buyers, price is traded lower, we traded into this 4 hour, let's say, and our stop loss was here. We're in a little bit of profit. We're in quite a little bit of profit. Didn't tap it, but we thought we'll let price roll. And after market open, price opens up above here in this area. So say your stop's there, say you're risking 2%, you're pretty much risking like nearly like 3% now. Like, market won't close you out at this price, it will skip above, and the next available candle that is printed, it will close there. And most traders slip up on this and end up blowing their accounts through like max drawdown limits and stuff because they think they're risking 2% or they've gone break even, and then market opens and it just smashes straight through their break even or stop loss, and they're losing double of what they think. And let's say you're risking 2% and you lose 4%, that's probably your account gone through max drawdown limits, especially on prop firms. But yeah, next point, buy side and sell side liquidity. Like we talked about at the start, so we're going up to take out sellers in this market. So banks are trying to take liquidity out of the market to predict the next move, to move back down, so create enough volatility out of this to move back down. But to move back down, it's going to need more sellers in the market. So it's wiping out the buyers to allow for more sellers, and that's why we're wiping out all the buyers through here. They have the stop losses here, and they're all getting wiped out, which opens up for more sellers now. Like, people are able to purchase more sells, for price to start moving down to again, then now you start wiping out people selling, selling in the market. Right, now next point on liquidity is I'm going to talk about a bit of slippage. Slippage is, say market open, right, I've learned this through experience. Market opens, you see a position, please do not take that position straight off market open. Wait for a session, because when market opens, say it's a bit volatile, the prices, they're not balanced yet. It's hard, it's really confusing, it's hard to explain, and I found this really tricky when I first started trading. But the prices hadn't settled yet. So say you're buying, you think you're buying at this price, but price puts you at a stupid open, like your entry's nowhere near of what you expected it to be. That's because price hadn't settled yet, and it's you just need to let price settle and let volume grow in the markets to avoid this spread. But yeah, I've learned that through experience, and it's, you can open a position and instantly be like 1% in drawdown, and it's like, whoa, what's happened here? But trade sessions only, because even as a swing trader, you want to be careful of setting limits and getting tapped in off market open and stuff, because you're just not going to get entered at a nice price, and it's just not a good way to start off your trade, because you're just taking out profits that you could have just waited till London session, let's say. Right, so now with liquidity, I'm going to talk about market structure and how people react off these liquidity sweeps and how banks take this to their advantage. Because like I said again, like even say you have a live account, like with a live account, you buying into the market, let's say 10 lots, you're not having any effect of what banks are putting into these markets, because the price is just totally different. Like you're such a tiny little like blob compared to these banks, like how much money they put in compared to how much money we put in. We're in the markets and out, they're holding until like probably a long time. So yeah, let's get into market structure and how price reacts off liquidity, and what can be deemed as different areas of liquidity. So like some people, let's say this 4-hour example, some people just trade off pure top of the wick sweep. Some people maybe that trade lower time frame, trade off maybe like London session, New York session, Asian session wicks. So this full thing can be classed as a liquidity, like this full area is liquidity. As yeah, price reacts off sweeps and highs, but this full area, price can just grab liquidity and just move straight off it. And I feel like a lot of traders use that so they don't really miss the moves, because sometimes price don't sweep the full liquidity and it just carries on moving. Like for example here, I don't think that wick would have even got it, to be fair. No, it would. You could say this wick, enough liquidity has been grabbed here, and then price starts moving up as there's more buys open into the market, as the sellers have been, as the buys have been wiped out here, which allows, as they've been wiped out, people keep selling, keep selling. All their stop losses lie here, and then price has to push up to take out those sellers. And then again price moves back down and then finally sweeps this. But different areas can be deemed as liquidity. And yeah, thanks for watching, and that is a good educational video. Quite tightly packed, but good, well explained video on liquidity that I hope can help you in these markets.